Okay, so you responded to compound interest and dollar cost averaging and how to protect your actual capital. So I'm going to touch on all three of those. I'm going to start with dollar cost averaging, explain a little bit how it works, and what it is and how it works. Also compound interest, exactly what it is and how it works. And then lastly, I'm going to do probably the most important, and that is to how to protect that growth of your investment right close to the end. So hold on for that. That's going to be a very interesting little thought, that how we do that. Okay, so great. So dollar cost averaging is very simple, is that is a average across the market. So you would contribute on a monthly basis. So every month you're contributing and you're purchasing units on a monthly basis. So you would invest, let's say, $2,000 a month, and you would purchase an X amount of units. It might be 1, it might be 1.2 of units, it might be 2 units, it might be 100 units, but you're going to buy a certain amount of units. Month 2, the market is slightly off, and this is when you're going to buy a little bit more units with exactly the same amount of contribution of $2,000. The following month, the market could be slightly up from the first time that you invested, and so you would pay a little bit more. And so now you've got an average. You've got 3 months. I'm just making it quite easy. You've got 1 month that was low, you got 1 month that was average, and you got the 1 month that was a little bit higher that you purchased for. So it brings you out an average. That's what they call dollar cost averaging. So you don't have to try and now be some sort of expert where you are timing the market, you're knowing when to buy, you're knowing when to sell, you're knowing when to predict the market, and you're sitting 24 hours in front of your computer and trusting that you're going to make a success out of your investment, and with it goes a substantial amount of stress. So let's cut all of that out, and we do dollar cost averaging. I spoke to someone else the other day on YouTube, and he simply said, his name was Andrei, and he simply said, I stick to dollar cost averaging. So even the fundies and the influencers and the best influencers, the top influencers in the world of YouTube say dollar cost averaging is what we follow. Okay, so that was his advice. That's what he said to me and the other day when I'd asked him a particular question. Dollar cost averaging is what he follows. The next is compound interest. So how compound interest works is basically you're earning interest, and the following year you earn interest upon that interest. So you are building interest upon interest, and that's what they call compound interest. So that's how your money builds in a much quicker pace, but yet you will not see it too much in the first couple years. Once you get to year 7 or 8, generally you'll be, if you were investing $2,000 a month, that'll be $24,000 over a period of 1 year. And generally you would start to see that in year 6 or 7, that compound interest will actually be kicking in, and you will tend to see that your interest will be higher, at least equal to, but generally higher than your contribution is. So if your contribution is $24,000, you'll find that your interest will generally, at around about year 7, you'll find that your actual interest is now higher than your contribution. Okay, and the graph does that sort of, and it starts to really at year 7 or 8 begin to turn in a very quick upward direction. So that's interest upon interest earnings, called compound interest. Okay, so now we're going to touch on the little one about protecting your capital.
Whoa! Whoa!
So typically, if you were to invest $2,000 a month, and at the end of the year, $24,000, and at the end of the actual 5-year term, a 5-year term, I'm taking an example, that you would be on 120,000 contributed. With a decent to average return, you would then simply not be on 120, obviously, with some compound interest and some interest on annually. You would be sitting on around about $160,000. So what typically we as a business would do would take the $160,000 out of that investment account, put it one side into a different investment that has a fixed return. So it is a capital amount with a fixed annual income. So it is not fluctuating with the market at all. So while you continue with your dollar cost averaging on this side, you continue to pay your monthly contribution, whatever that may be. We've used an example of $2,000 a month. You continue to pay your $2,000 a month. You continue to buy dollar cost averaging and utilizing dollar cost averaging and the compound interest. You continue to do that for the next 5 years, and you're buying units regularly. But remember, here's the interesting thing about the stock market, and which you probably will know, is that every 1 out of every 5 years or 4 years, so you're going to have 2 or 3 years out of a 10-year period that runs on not such good returns or even negative returns. But dollar cost averaging overrides that. So that's fantastic. But what it doesn't override is your capital. So when it gets to that dip, your capital dips with it. And you're going to trust that it turns up again, but now your capital's taking a dip with it. So what we do is we simply take out, after about a 5-year period, we remove the capital so that it's not affected by the market anymore. And it gets a fixed return on the side, a really decent fixed return that has no correlation to the market whatsoever. So now your capital is effectively protected, while at the same time you continue. So in other words, your 160,000, literally, if you continue to contribute, your 2,000 will literally double and end up at around about 320,000, but your capital grown on the side will turn that into 480. So literally you can earn yourself around about 50% more in interest if you protect it. That obviously could grow to that amount on its own depending on what the market does, but the problem is if you don't protect your capital at year 9 or 10, if the market takes a dip, and that's when you're about to access your capital and make it liquid, you could have a negative, and you could have to wait another 2 or 3 years before you could actually say, okay, I did have a decent return on my funds. Whereas if you took it out on year 5 and protected it, then you've protected half your capital and allowed compound interest to continue on the side at the same time. I trust you understood everything I've said. If there's any further questions, just click down below and ask for further information. What you could do as well is, of course, just click below, and there's a place where I will evaluate your current investments that you are doing. You click below, and I will then, once you've given me those current investments, you simply issue that information to me, and then I will give you back a personal video. Within 24 hours you will receive a video back, and I would have analyzed exactly how they've performed, your current investments, and how they're likely to perform going forward, and if there are any adjustments that could be made. So please click below and let me see if I can assist you to make your investments grow in the most successful way.